Welcome to Iron Financial. Look, our mission here is simple, and it's always the same. We want to help you forge a stronger portfolio and cut straight through the market weakness with relentless data-driven analysis. Today, we are conducting a rigorous structural stress test on an absolute retail giant. We're putting Dick's Sporting Goods, ticker symbol DKS, and their massive Q1 2026 earnings report right under the microscope in this explainer. If you're looking to build wealth that actually lasts, go ahead and hit that subscribe button right now.
That's right, because we are looking for the absolute truth today. They just closed this massive $2.5 billion acquisition of Foot Locker, and naturally, management is out there selling a story of unstoppable growth. But, as always, I'm here to represent you and ask the hard questions. Dropping $2.5 billion in today's highly volatile retail environment, where consumer credit is largely tapped out and discretionary spending is under heavy pressure, that is a massive risk. So are we looking at a titanium-grade investment opportunity here, or is this just a structural value trap hiding behind a really flashy corporate PR campaign? Well, let's find out. Let's inspect the framework.
We have to start with the headline number that came out absolutely swinging in Q1. Consolidated net sales rocketed up by 62.7% year over year. That brings them to a staggering $5.17 billion for the quarter. I mean, that is a massive top-line acceleration. To put that into perspective, in the traditional retail sector, seeing a revenue jump of over 60% is literally like watching a skyscraper go up overnight. It just doesn't happen.
Okay, hold on a second. Let's not get blinded by the scaffolding here. Yes, a 62.7 jump looks incredible on a press release, but we've got to ground this in reality. Look, if we were analyzing a high-growth SaaS tech company, sure, 60% might make sense. But in traditional brick-and-mortar retail, sustainable organic growth is almost always in the single digits. So we really have to ask, is this actual organic structural strength coming from the legacy Dick's Sporting Goods core business? Or is this just the artificial inflation of welding a massive, struggling asset like Foot Locker onto the balance sheet? Because let's be real, buying revenue is easy. Anyone can do that. Forging profitable, sustainable growth, that's the hard part.
And that is exactly the stress test we're running today. To answer that, we have to completely isolate the original structure from the new addition.
Section 1. Inspecting the core foundation, the legacy Dick's business.
Before we even think about touching the Foot Locker acquisition, we have to inspect the load-bearing walls. If the core foundation of Dick's is showing cracks, there's absolutely no way it can support the heavy lifting required to integrate a multi-billion-dollar turnaround project. But as you can see here, the foundation isn't just holding, it is carrying the weight with plenty of room to spare. Back in Q1 2025, they delivered $3.24 in GAAP earnings per share. And remember, GAAP stands for Generally Accepted Accounting Principles. That is the strictest, most rigid standard for measuring bottom-line profit. Now jumping to Q1 2026, they pushed that EPS up to $3.54.
Okay, a 30-cent bump is nice, sure, but why are you saying this is so critical to the foundation?
It's absolutely crucial because of the dilution. To acquire Foot Locker, Dick's had to issue 9.6 million brand new shares of common stock. Think of share dilution like slicing a pizza into more pieces. Usually, when you add nearly 10 million new slices to the pie, everyone's individual slice gets much smaller. Usually, the earnings per share gets completely crushed under the weight of that dilution. But the Dick's core business is such an absolute cash-generating engine that its profits grew so fast, it completely offset those new shares. They absorbed the dilution entirely and still managed to grow EPS by roughly 9%. Every single slice of the pie still got bigger despite there being more slices. That is the very definition of structural integrity.
All right, fair enough. The bottom line held up under the weight of the new shares, but we both know earnings can be engineered, right? You can tweak things with share buybacks and ruthless cost-cutting measures. What I want to know about is the top line. Are athletes and everyday consumers actually still walking into the physical stores and buying gear?
They absolutely are. If you strip away the Foot Locker noise entirely, the standalone Dick's business delivered a very solid 6.0% comparable sales growth. Let's quickly define that for everyone. Comparable sales, or comps, measure the revenue generated only by stores that have been open for at least a year. It essentially strips out the artificial boost you get from grand openings and proves whether the existing, established footprint is actually healthy. I'll give credit where it's due. In an environment where the broader consumer is heavily pressured by stubborn inflation and high interest rates, putting up a 6% organic comp is undeniably strong. It means their existing physical footprint is highly productive right now. They aren't just surviving the macro environment, they are actively gaining market share and completely outpacing the broader sporting goods industry. But I also know management isn't just sitting still and collecting cash on their current stores. They're spending heavily to completely change the architectural blueprint of the business.
Exactly right. They are aggressively repositioning their real estate portfolio to widen their economic moat. Look at this blueprint. They have built 35 Dick's House of Sport locations. And these aren't just stores. These are massive, highly experiential retail destinations. They've got 14 more planned to open this year and another 18 in 2027. Then, you've got 42 of their new 50,000 square foot Fieldhouse concepts currently open, with 22 more on the way in 2026. Plus, they're rolling out these high-tech Golf Galaxy Performance Centers, 33 open now, 15 planned this year, which are equipped with advanced TrackMan technology. They aren't just building stores, they are building massive, interactive retail fortresses.
But fortresses are incredibly expensive to build and maintain. These aren't just your standard run-of-the-mill big-box stores with endless racks of clothes and a couple of cash registers. We are talking about maintaining indoor rock climbing walls, fully functioning batting cages, and outdoor turf fields. Honestly, it sounds like an absolute insurance nightmare to me. That strategy is incredibly capital-intensive. It requires heavy lifting on the balance sheet, it vastly increases their liability, and it requires specialized staff to operate safely. So my question is, are these experiential megastores a durable, long-term foundation for the future of retail, or is this just a really costly fad that's going to bleed cash the second the novelty wears off?
Well, management is definitely betting that those 6% comps prove the athletes actually want that physical experience. But your point about capital intensity is totally valid, and it leads us directly to the absolute biggest stress point on this entire balance sheet.
Section 2. The Foot Locker Weld. Integration Challenges. Look, this right here is the make or break moment for this entire explainer's stress test. They paid $2.5 billion in a mix of stock and cash. And now they have to somehow weld a completely different company, one with its own bloated inventory and deep structural issues, onto the pristine Dick's framework. And frankly, let's be honest about Foot Locker. They've been bleeding foot traffic and closing stores for years. The structural drag is so obvious when you put the two side by side on this slide. You've got the DKS standalone business roaring ahead with that plus 6.0% comp sales growth. But then you look at the Foot Locker pro forma numbers, meaning their adjusted historical numbers that assume they've been together under one roof for the whole period, and they put up a measly plus 0.6% comp. That is dead weight. It's pulling down the overall consolidated numbers to 4.1%. I just have to ask, why attach a heavy, rusting anchor to a speedboat?
I hear you, but you're looking at that 0.6% as a weakness. In the context of a massive retail turnaround, hitting 0.6% is a massive structural victory. Let's remember, prior to the acquisition, Foot Locker was firmly in negative territory, bleeding out quarter after quarter. Pulling them from negative comps all the way to a positive 0.6% and critically returning that specific segment to profitability with $17.5 million in segment profit, that proves that Dick's playbook is actually working already. They went in and stopped the bleeding.
Okay, fine. Applying the tourniquet is step one. But how exactly are they doing it so fast without completely tearing down the entire brand heritage that Foot Locker has built over decades?
They're executing a highly efficient, capital-light remodel program that they're calling the Fast Break Initiative. They aren't going in and rebuilding these stores from scratch. They are surgically fixing the merchandising structure. They started small with an 11-store pilot program. Then they quickly expanded to Los Angeles just in time for the NBA All-Star Game to get maximum visibility. And now they have rapidly scaled it to roughly 100 stores globally in Q1 alone. The ultimate target here is to have roughly 250 remodeled stores ready to go by the absolutely crucial back-to-school season in 2026.
Okay, but what exactly does a fast break remodel actually entail? Are we just slapping on a fresh coat of paint and changing the overhead lighting? Because that's not a real turnaround.
No, it's really about clearing out the garage. They went in and ruthlessly removed roughly 30% of the unproductive, low-selling shoe styles from the wall. In retail merchandising, eliminating choice paralysis is huge for the consumer. By clearing out all that visual clutter, they completely clarified the brand storytelling, and they freed up highly valuable shelf space to showcase the premium footwear that athletes actually want to buy. And the results? They're undeniable. These fast break stores are currently generating double-digit comps and significantly improved merchandise margins.
Fine. The fast break strategy sounds operationally efficient on a micro level, but fixing 250 stores out of thousands is still just a drop in the bucket. I want to see the real agonizing cash cost of this integration. Let's look at the actual damage.
Section 3. Cracks in the armor. Integration costs. I am halting the bullish narrative right now, because turnarounds are rarely cheap, and let's be honest, they are never as smooth as management claims on a highly sanitized earnings call. We need to dig into the actual liabilities here. We need to find the cracks in the armor caused by welding these two massive corporate entities together. Because this right here is where the capital is severely bleeding out. Management is projecting a staggering $500 to $750 million in total pre-tax integration costs. Just look at this table and see what they already burned through in fiscal 2025. That top line, $217.9 million purely to write down and liquidate garbage inventory. That literally means physically taking unsellable shoes that Foot Locker had hoarded, marking them down to pennies on the dollar, and taking a massive financial loss just to get them out of the warehouses. Plus another $164.2 million in legal, regulatory, and merger fees.
They had to clean house. You have to pour a fresh concrete slab to establish a new operational baseline, right? You can't build on top of bad inventory.
I get that, but it doesn't stop there. Moving into 2026, we are looking at another $150 to $200 million in expected charges. This includes up to $55 million just in severance and relocation costs. That is the painful human and structural friction of a merger, firing redundant staff and forcing others to relocate to the New York City headquarters. Add it all up, and that is nearly $750 million flying out the door just to fix Foot Locker's bloated balance sheet and align the workforce. To me, that completely compromises the structural integrity of their near-term financials.
It is a massive capital expense, yes, absolutely. But you have to look at whether the core engine of the company generates enough horsepower to fund that heavy repair work without starving the rest of the business.
And the answer to that is unequivocally yes. Despite that $750 million Foot Locker bleed over the medium term, Dick's still has the iron strength to project $1.5 billion in net capital expenditures for 2026. Think about that. They are not slowing down their physical expansion at all. They are still fully funding the 14 new House of Sport locations and those 250 fast break remodels.
Okay, but announcing you are going to spend $1.5 billion is easy. Proving you have the actual cash flow to sustain it without taking on toxic debt is entirely different.
But they proved it. They proved it by aggressively returning capital to their shareholders. Alongside this report, they announced a 3% increase in their quarterly dividend, bringing it to a $5 annualized payout per share. That is their 12th consecutive annual dividend hike. Listen, a dividend hike is the ultimate put your money where your mouth is signal to Wall Street. A management team that is secretly worried about cash flow during a messy merger simply does not hike its cash payout for the 12th year in a row. They are operating from a position of absolute financial strength, plain and simple. Section 4, Blueprint for 2026, Full Year Guidance. So the core foundation is solid. The heavy integration costs are safely contained within their cash flow, and the early fast break metrics are really promising. Let's look at the forward blueprint and see what this combined retail fortress looks like for the rest of 2026. Honestly, the guidance is incredibly strong. They actually went ahead and raised the low end of their comparable sales outlook for both segments. The high-margin Dick's Core is projected to do over $14.5 billion in sales with a massive 11.0% to 11.4% profit margin. That brings in upwards of $1.68 billion in segment profit.
Sure, but the Foot Locker business is a completely different story on this table. They are projected to do $7.6 to $7.7 billion in massive top-line sales, but look at the segment profit. They are only extracting $110 to $150 million in profit. That is a razor-thin 1.4% to 1.9% profit margin. It's a heavy volume business with barely any financial yield right now. Now, I know management claims they are going to find $100 to $125 million in medium-term supply chain and procurement synergies. But what does that corporate buzzword actually mean? Closing duplicate distribution centers? Firing redundant middle management and human resources? Merging IT systems that don't want to talk to each other? I remain highly skeptical that those synergy dollars will actually materialize to boost those anemic margins. We've all seen this movie before. Synergies usually look great on a spreadsheet, but fail spectacularly in actual boots-on-the-ground execution.
Look, the margins are razor-thin right now because they are actively in the middle of tearing it down and rebuilding it. That's just the reality of construction. But if they successfully apply the Dick's playbook and actually realize those supply chain efficiencies, the upside profit potential on $7.7 billion of revenue is absolutely enormous.
And that brings us directly to the operational mindset of the leadership team. CEO Lauren Hobart stated it perfectly on the call. Sport is one of the hottest categories in the country today, and Dick's is leading from the front. We're investing from a position of strength and playing offense for the long term, widening the gap between us and the rest of the industry. This translates perfectly into our iron financial trader speak. They are aggressively widening their economic moat. They are building a physical retail fortress, and they are playing relentless offense by acquiring wounded competitors like Foot Locker and basically forcing the rest of the market to play an exhausting game of catch-up. I will acknowledge that they are playing an incredible offensive game right now, but let's keep our heads on a swivel. Playing relentless offense inherently means you are somewhat overextended. If the broader economy tanks, those massive capital expenditures on experiential stores, combined with the razor-thin Foot Locker margins, well, that leaves their flanks completely exposed.
Section 5. Opportunity or trap. Final verdict. All right, we have thoroughly inspected the foundation, we've calculated the agonizing cost of the weld, and we've reviewed the forward blueprint. It is time for the final definitive verdict on today's stress test.
We have laid out all the data. Now we have to answer the ultimate question for our listeners who are out there trying to forge a stronger portfolio. My final ruling? Dick's Sporting Goods, ticker symbol DKS, is absolutely built to last. They have an iron-clad core business putting up 6% organic comps. They completely effortlessly absorbed the Foot Locker share dilution. They've proved the fast break turnaround model actually works, driving double-digit comps in those initial 100 stores. And most importantly, they have the sheer cash flow to sustain a $1.5 billion capital expenditure build-out while simultaneously raising their dividend for the 12th straight year. This is a structural fortress you want anchoring your portfolio.
And here is my ruling. It is an opportunity, yes, but it comes with a very heavy warning label. That $750 million in integration costs and the dangerously razor-thin 1.4% margins over at Foot Locker are real, immediate liabilities. If consumer spending cracks any further, those massive experiential House of Sports stores could very quickly transition from unassailable fortresses into incredibly heavy financial burdens. But I will concede, right now, their structural integrity is holding up better than almost anyone else in the retail space.
Now we want to hear from you. Will the Foot Locker acquisition be the ultimate growth engine or a fatal structural flaw in the foundation? Let us know down in the comments. And if you want to keep cutting through market weakness and forging an ironclad portfolio, make sure you hit that subscribe button. We will see you on the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.